Good afternoon and welcome to yet another TUG Connects 365 webinar today. I'm Gloria Nelson, your host with TUG, and as you settle in and get ready for the start of today's webinar, let me give a brief introduction for TUG, the usergroup.org, for both our current members and those of you who are not yet members of our Infor community group of distribution software users. We've all heard that phrase, knowledge is power, and I can say with confidence that after today's presentation, you'll be waking up with a little more of both. And today is but one of our many presentations we offer. TUG webinars, online forums, and member events facilitate the timely exchange of ideas and information to help you work smarter and with more confidence. Now that's a powerful combination. If you're currently a member, it pays to get even more involved. And if you're not, please visit our website to discover why 2,300 heads are better than one to help you be the best at what you do every day. I'd like to also give a quick informational announcement on intellectual property. Our presenter today has given us permissions to have you take screenshots and grab chat as you need in order to be able to grab that pertinent information that you want to come back and focus on. Now, it is our pleasure to welcome Brent Grover, M&A expert. Brent is an NAW Institute Research Fellow. He's long been recognized as an expert author of 9 books and countless articles, as well as being an adjunct professor at Case Western School of Management. And Brent, I understand you also have a great history with TUG in a number of different fashions over about a half a dozen years. So Brent, it's all yours. Go ahead and take it away.
Okay.
And I have you on my sight line.
Are we okay?
Have you on my sight line.
Okay, good deal. This is Brent Grover. Hi, everybody. It's TUG time again. We're back virtually. As Gloria was saying, I've been to TUG Connect a few times. How many? Maybe 7 or 8, or maybe 6, but a bunch of times. And I've also been privileged to be a speaker, thanks to Gary and Karen, on multiple occasions, including the first executive conference, which I think that was in 2016 or so. Anyway, it's nice to be back. And the topic of the day is M&A, distributor M&A from the vantage point of the seller. And the reason for that is, I think, talking here to a group of mostly business owners, operators, not large publicly held companies in distribution. So our perspective here is to talk about transactions from the vantage point of the seller, not the buyer, although, of course, it's a mirror image. But besides bragging rights here about some of the transactions that I've advised on, these are all working with the seller, although I've done both sides of the transactions, buyer and seller. I just wanted you to see what these companies, what the buyers were like. For example, you'll notice that 2 of the buyers were strategic buyers, meaning it was a competitor, or it was the company, in one case, buying the stock back from a shareholder. But the other transactions there, where it says quasi, what that means is the buyer was a strategic buyer, a strategic company owned by a private equity fund. So talking about private equity funds is going to be a very big part of our conversation today. So I'd like to start out, Gloria, with a poll question here for everybody, get you engaged. The first question here is, from your viewpoint as an owner or a prospective seller, I think every owner is a prospective seller, which of the following concerns you most? And I'm sure they all concern you a bit. But I'd like you to just pick one of those 4 that concerns you the most right now, and might be a motivation if you weren't thinking of selling before. Maybe you are now due to this uncertainty. So, Gloria, if that's enough time for everybody to respond, we could take a look at the responses. So here we are. Number 1. Rollout of the vaccine. And I sure can feel that one, because so many companies in distribution have had their sales and margins dramatically affected, both bad and good. Good from the vantage point of people selling COVID or pandemic supplies like hand sanitizer and masks and gloves at 40% margins and really giving a boost to sales and overall margin percentage in the past year. And the big question there is how long will this last? And how much inventory might we get stuck with at the end? Now, I also see number two there is inflation and interest rates. And right now, we all know we're kind of at the low point historically on inflation and interest rates, but I think it's an astute observation here. We see the government, our government, spending a lot of money to try and resuscitate the economy and protect the citizens, and we all know that's added debt. It's going to have to be paid back at some point. So inflation and interest rates are something that most of us haven't forgotten about. Look at the global tensions there. A significant number of people, over 20% there, you're suggesting global tensions, and they're affecting us whether you're a buyer from overseas or a seller to overseas customers. That's certainly an effect. And then federal and state income taxes. Interesting, that's the lowest percentage of those four. I'm going to tell you some things later that might cause you to rethink your positions if you don't think that's a big issue for you as a prospective seller. Okay, so we'll close this panel here, poll rather, and go on to the next thing. This is just sort of a table of contents here, and the way I look at it, we're just having a chat. You notice I don't have any notes in front of me. We're just having a conversation as if you and I were sitting in a couple of comfortable chairs in your office or somewhere else and having a nice cup of coffee and talking about M&A from the seller's viewpoint. Obviously, pandemic, valuation issues. Valuation's been affected by the pandemic. There's also the things that haven't changed. Looking for a good fit between the buyer and seller. How do you attract offers? What's the deal process look like from the seller's vantage point? What does the buyer's due diligence do as far as the deal, as far as possibly killing the deal or causing the buyer to try and renegotiate the deal? Also, risk factors in putting your company up for sale as a distribution business. I think distributors face some special risk factors. And then what happens after the closing? I mean, there are things that happen that are not always a pleasant experience for the seller because you may believe when the check clears at the closing that's the end of it, and it usually is not. There's more to be done to complete the deal. So big questions here. Overall big questions. Did you miss an opportunity to sell in 2019? And I'm using that broadly because obviously the pandemic world didn't really start till March of this past year. On the other hand, if you hadn't already started to put a deal together way before that, did you miss an opportunity? In knowing that most deals take at least 6 months to put together and do the due diligence and get them closed. So you would have had to start quite a long time before March 2020 if you were going to close by then. And the second or the follow-up question would be looking ahead to 2021. Will you be able to expect to find a good buyer in 2021, assuming that's something that you're wanting to explore? A little macroeconomic sense here, and that is look where our manufacturing capacity utilization is as an overall U.S. economy right now. 72.6%. It was 72% in October. It's 72.6% in December. That's not good in the sense that low capacity utilization means the companies don't have much pricing power. And there are a few of us, except in specific commodities, who expect prices of products to go up much in the coming months. So that's a factor, though, and that it's a long way to get back to. You can look on there to the 80% range, which is where companies start to have enough pricing power to raise their margins. Now, as far as privately owned distributors, people such as yourselves, myself when I was in the business many years ago, and I sold my company to a private equity fund over 20 years ago. So that's how I really first got deeply involved in the process of helping others sell their businesses. But of privately owned distributors, this is a straw poll. December sales overall down about 10% from last year. That's a sweeping generalization because that's really mostly looking at industrial distributors or distributors who sell products to industrial companies, and that may not be you. Also, 2021, the expectation is growth of 7% next year over this year, and the overall 2020 came in around 12%. Sales declined for, again, that particular type of distributor. If you really like to see definitive information on this, because this is just a straw poll, there's a company called Cleveland Research that does an excellent job with scientific polling of privately held distributors, and they publish a report every month that you might be interested in. Pricing expectations, again, up slightly because that low utilization rate of manufacturing capacity at this time. Overall, it's fair to say that business owners, distributors, privately held distributors, expectations and sentiments have improved somewhat, but they kind of stabilized at the current level. There's too much uncertainty right now, and I think it's kind of put the kibosh on some of the good feelings. And I already mentioned the effect of pandemic products on some distributors. It's been a lifesaver for some. Now, as far as M&A activity in 2020, it was very disrupted, and I won't read the slides to you, but you can see the volume dropped by in the first half of 2020 dropped by about half compared to the prior year. That's the number of transactions, and the 22% drop is not in prices paid for specific companies, of course, but rather just the overall number of dollars of sales that took place during that time. But it really did bounce back, and I'll show you that. But the exception to the drop off was private equity funds that owned companies that were looking for platform opportunities, and that's really for them that's the holy grail, is to buy a distributor that is big enough that it has the full array and range of services and support, management team, sales, IT, etc., that the company could be considered to be a platform to enter a new distribution industry and then to add other companies to the platform. Those are always in demand and have continued to be. Most of the transactions, though, private equity companies are buying distributors. They're buying smaller companies to bolt on to existing platforms that they already own. And there's another factor that drives purchasing of companies, that is strategic buyers have a lot of cash. And in fact, I think it's safe to say that almost all of the distributors I know, even if business is down significantly compared to a year ago, they have a lot of cash. And of course, when your business is soft, when sales are soft, the cash box fills up because receivables and inventory are turned into cash. And then you've got your PPP money, hopefully sequestered, what's left of it in a separate place. Because, of course, it may be recurring now that they're reopening the window for PPP, but that's not something that's going to be sustainable into the long-term future. Now we're turning to the area of prices and multiples. Everybody's interested in that. This is from a source called GF Data. What this is showing you is a comparison of the multiples paid, and I'll just tell you what those abbreviations mean. TEV is total enterprise value. That means the equity of the company plus its outside debt, such as bank debt. Doesn't include accounts receivables or accrued payroll or anything like that. The debt there is the outside debt that would have to be paid off if the company were sold, of course. But that's the total enterprise value divided by, everybody knows what EBITDA is, or it's a proxy for cash flow. It's imperfect because there are variations in different situations where cash flow has to be adjusted. But in a typical situation here, look at year-to-date 2020, distributors are right in there, 7.9. It's a whole turn less than media and telecom, and about a half a turn less than technology, but it's right there with healthcare services. So Distributors are not the redheaded stepchild, if I could still use that expression, but you can see that they've held up pretty well compared to others. This is just a comment about PE activity because it's so important to the valuation of distributors. Distributors have been selling for very good prices for the last few years, and a primary reason for that is private equity funds are joining the bidding wars for distribution businesses. So your only option used to be selling your company to a strategic buyer, in other words, a competitor. And today that is definitely not the case. There are more companies that are bought up by private equity, either as platform companies, as I mentioned, or as bolt-ons, which I mentioned also. But you can see this is year to date, in third quarter, the number of PE activity deals that had dropped off by half in terms of the number of deals closed, and by more than half in terms of deal value. Again, that's annual. That's year to date through the third quarter, not annualized, and that's private equity activity in all sectors, not just distribution. So we need to get a little more specific. But before we leave the thought of the strategic buyers, I just want to mention: look at all the cash on corporate balance sheets, and that's as of the third quarter 20. I think if that were updated to the December numbers, that would be much higher. And of course, it's a combination of the same reasons that distributors have a lot of cash apply to most other companies as well. Now, these are transactions sponsored by private equity funds, and again, the source of this is GF data. What this means here again is total enterprise value that's the light blue bar there, divided by adjusted EBITDA. So if you look over to the vertical axis on the left, it's telling you the multiple, which was for 2020 first half around 7.3. And it's a bit higher, might surprise you, than it was 2019, even though the number of deals had dropped off. Reason? There are a lot more big deals in there, and big deals, larger transactions, rule of thumb, the multiple is higher. There's less risk for the buyer on a bigger deal, and the buyers tend to be bigger companies, and they do a lot of business with the lenders who give them better opportunities to access funds, really for two dimensions. One is they're willing to lend a larger proportion of the purchase price to a known large customer, and they're also able to give a better interest rate deal in those covenants in a situation where they're dealing with a larger buyer. So that's why larger deals tend to have higher PE multiples. And then we're going to dig, peel the onion back by one layer here and talk about if PE funds and for example, other financial type buyers, but mostly PE funds, if they have been driving the prices up, what about the money they borrow? And that's the underlying, let's say, the key to the multiples that private equity funds are willing to pay, which is the more they can borrow, the more they'll pay you for your business, because the deal makes more economic sense to them as buyers if they can use borrowed money to leverage the deal, because of course they're paying the lender a interest rate which is an historic low rate, and all the upside of the transaction comes to the buyer. So I'm sure that makes economic sense to all parties concerned here. But what happened in the second quarter of 2020, where the leverage multiple dropped below 3, and this is for deals with an enterprise value below 50 million, which would be considered in the grand scheme of things smaller transactions, not necessarily small. So what's going on here is that in the second quarter, the Treasury policy on issuing Treasury bills and notes and bonds was affected by the government's decision to have less of those available for the banks to use as collateral for their borrowing. And not to make this into economics 101 or 201, the more money that's floating around out there that the banks can use as collateral for their loans, the more they can borrow, and then in turn they'll lend more to their customers. So there was a panic time there for a couple of weeks in the second quarter when it looked like the loan window was closing, but it popped right back, or almost all the way back. So you can see in the third quarter they were lending 3.2x. What that means to you is, let's say a buyer is wanting to buy your company. If they can get 3 times the purchase price, I'm sorry, if they can get 3 times EBITDA, your EBITDA, they're using your earnings to leverage the deal. If they can get 3 times, maybe they're willing to pay you 6. If they can get 4 times, they're going to be more willing to consider paying you 8. Of course, they never want to pay you more than the market price. But the point is, for them to get to the market price, the more money they can borrow at the better terms, the more money they'll pay you as the seller. So these leverage multiples are important to you as a seller. And this is just another table that shows another one from GF Data. It demonstrates the effect that larger deals, there's higher multiples. If you look at the third quarter 2020, there's a little aberration there. The very smallest deals were 3.2, and then the next one is 3.8, and then as you can see, it goes 3.8, 4.2. But that's the kind of the typical world you're looking at. And when they can borrow more, they'll pay you more. And that's one rule of thumb. And the other one is, the bigger the deal, the bigger the buyer, typically the better deal they can get from the bank, and the more they're able to justify paying you to get to that market price. So, Gloria, it's time for another poll. So here's a question for you. If you were to sell your business, pie in the sky, would you be willing to, or would you want to work for the new owner? I'm interested to see what you have to say there, because sometimes people have very strong feelings about this one way or the other. Some people really want to work for the new owner. Some people really don't. And other people are more, opportunistic. So, Gloria, if you feel we've given people enough time to answer this question, we can take a look at the answers. I'm not seeing them yet, Gloria. There we are. Look at that. Nobody said no. Beautiful. This is the group of smart people in this audience. And 2/3 of you said, for as long as necessary to make a smooth transaction. That's the usual answer, or for as short a time as possible. So I guess the rule of thumb here is, you're broad-minded enough to know that in order to get the best deal on the sale, you may have to stick around for a while, either to ease the transition or just to be available to help if needed. And a small number of you want to stick around till normal retirement age or longer. That's part of the art of finding the right buyer, is finding one that meets your needs, both financially, but also on a personal level for the things that you want to do. So continue on here to the subject of valuation. This is going to require a little more work on your part, and I'm going to explain, but you're going to have to put your thinking cap on a little bit here. The first point I want to make on this screen is in the top, which is, you look at these publicly held companies like Fastenal, and this is really current information, Fastenal and Grainger. You look at those companies and you notice, first of all, where the first red arrow is, their EBITDA margin, which is their EBITDA as a percentage of sales price. Those are pretty heady numbers, more than most smaller distributors are able to achieve, with the exception there of Genuine Parts, which is, they have other businesses, but they're the parent company of Motion Industries, so a big distributor. So having said that, there's a nice array of choices there. Pool Corporation is a bit lower, 12.1. But then if you go across to the far right, you can see the price of the stock in relation to the sales per share. So a share of Fastenal is selling for about 5 times the sales per share. And if you look at another one there, Pool Corporation, 3.7 times. Now, of course, you could apply some other things to that. The pool business has been very good during this pandemic era. Fastenal has been a remarkably good performer in good times and bad. It's been a wonderful stock to own for a long time. But if you recognize these companies, their prices are very high compared to what we would expect for most of us to sell our businesses. The only one that's kind of in the ballpark is Genuine Parts, which is selling for, let's say, 80 cents for every dollar of sales there, zero point 0.8 times sales. A lot of privately owned distributors sell for 80 cents on the dollar, sales dollar, or 60 cents on the sales dollar, which those would be considered in many cases very good prices. It's dependent upon the underlying economics. But remember, when you buy a share of stock on the stock market, you're just buying one share. You're not getting control. You don't get the whole company. When those companies actually are sold in a merger transaction, they almost always, unless it's a distress situation, they sell for way more than their day-to-day stock market price. So point here is stock market prices are directionally interesting, but they don't have a lot to do with what we can sell our companies for. The only thing they matter in a really direct sense is that strategic buyers, if they find their stock is flying high, they may have more of an appetite to make acquisitions and to pay market prices or maybe even above for acquisitions. But most of us don't accept stock from those companies in exchange for when we sell our company, we want cash, which is a whole nother subject, stock or cash, if you're selling to a publicly held company. The table at the bottom of this slide is about what EBITDA multiples you might expect if you had your company on the market today. Now, of course, this is dependent to so many variables about your company that it's impossible to make any general statement that's accurate. These are just directional in the sense that under 2 million in EBITDA, which would be considered a really small deal in most instances, whereas that a good company, a good solid company, might have been able to get 5 or 6 times a year ago for that. I would expect today would be more like 5. In other words, I would expect a loss of about a turn in terms of valuation, whereas the next step up is 2 to 5 million. 6 to 7 turns a year ago, maybe 5 to 6 turns today, and again, another loss of a turn. When you get to the over that category, 5 to 10 million plus, those companies are of greater interest to larger private equity funds, and they can command better prices. In fact, according to my own experiences and in talking to my friends, that 8 to 9 times for a larger company is holding up pretty well right now. And those larger companies they didn't really see much of a drop off in valuations. And then there's the so-called outliers. Those are still happening, and those are prices of 10 to 11 times EBITDA. I've seen a couple deals in manufacturing and technology that go much higher than that. But I'm just talking about distributors here. The little red box on the right, before I leave this slide, I want to mention the little red box. What we're talking about there is transactions where we've done a poll, a study in 2 books about wholesale distribution M&A. One was called The Acquisitive Distributor. Gloria, I see you there. I have a question. And the other book was more recent. I'll talk about it later. But the typical rule of thumb, looking at 100 or more transactions, 6 times EBITDA, 1.6 times net book value, about 30 cents or 0.3 times sales. That's sort of your garden variety deal. That's what typically can be found there. Gloria, what do you have?
Kathy Lundquist is asking the question, Brent, what attracts the attendee of a PE firm? And do you see that reasoning changing in 2021?
I don't see the reasoning changing because what's really got them going is they have a lot of so-called dry powder. Private equity funds have a tremendous amount of cash committed by their investors to make acquisitions, and they really want to invest that as quickly as they can. So that's the underlying reason. Now, how do you get their attention? That is through a deal process, and I'm going to address that a little bit later on if we can wait patiently, and we'll get there, okay?
Sure thing.
Great.
Thanks for that answer. And I just want to remind everyone that in tandem with Brent's comments, this is really a conversation. He wants to hear from you, wants to know what questions you have pressing, or if you have something that you've gone through experientially and want to share that as well. Please feel free to either jump into the chat or post that in the Q&A bubble. And with that, I'm going to go dark again.
Great. Hey, thank you. Okay, good. So let's continue on. I mentioned this is going to be a little bit harder work here for a second here. Here's a model. I'm not going to dwell on this, but I just want you to be aware of it. I hope you've seen it before. It's a distributor profit model. It's a variation on something that's been around for a long time called the DuPont model. But what we're doing here is we're saying, okay, guys, let's take a little distributor here, a $10 million distributor, 10 million in sales that has 300,000 in net income. So we have a fraction there, and the 3% number is the 300,000 of net income before tax divided by sales. So we have a 3% return on sales, which may look rather meager. Some investors would look at that and say, well, they're hardly even breaking even. But that's wrong. So let's see why that is. The next fraction there takes this little distributor with 10 million in sales and divide those 10 million in sales by their total assets on their balance sheet. Assets including receivables, inventory, whatever, forklifts and a computer, what have you. Usually not real estate. Most of us don't have real estate on our balance sheets, but the typical there is 4 turns, $4 of sales for every dollar of assets. So 4 turns times a 3% return on sales equals 3 times 4 is 12. 12% return on assets. And another way to calculate that would be to take the 300,000 in net income and divide by 2.5 million in assets. That's 12%. And then one more factor, which is our leverage at our company. 2.5 million in assets divided by 1 million in equity. Well, where in the world did I get that? What that means to you in your more normal terminology that we use is that we have 2.5 million of assets, we have 1 million in equity, we have 1.5 million of borrowed money, borrowed capital. We probably borrowed it mostly from our suppliers, it's accounts payable, and also maybe from the bank. So if we have 1.5 million of debt and 1 million of equity, we have a 1.5 to 1 debt to equity ratio. That's really low, by the way. But a very conservative 1.5 to 1 debt to equity ratio. But our asset to equity ratio here is 2.5 to 1. So if we take our little multiplication game here one step further, 3 times 4 is 12. That's our return on assets. 12 times 2.5 is 30, which actually is our return on investment. And if you go and multiply those fractions, remember you cancel out the numerators and denominators that are the same, and we come up with a numerator of 300,000 of net income and 1 million of equity, 30% return on investment. And even though this past year has been a pretty damn good year in the stock market, most of us probably can't say that we had a 30% increase in our portfolios, and that would be in a stellar year. How about owning a distributor that generates a 30% ROI year in and year out? What that proves is a very thin return on sales, 3% before tax. That can be equivalent to or can generate a very good return on investment if you have not too much leverage, or let's put it this way, you're not taking too much risk with too much leverage, but also that you're able to turn your assets over, which means you're managing your receivables and inventory well. So bear with me. I got to go through this fast because we don't have too much time, but I want to show you the rest of the story on this distributor. $10 million distributor, 300,000 pre-tax, 2.5 million assets, 1.5 million in liabilities, 1 million of equity. A typical case here, that 2.5 million of assets would be receivables, inventory, and the net fixed assets, meaning net after depreciation. And the rest of the balance sheet, the other side, the debt and equity side of the balance sheet would indicate about $750,000 of payables, some bank debt, and then our equity. So, what do you think this little distributor is worth? Have you already come to a conclusion? 300,000 in pre-tax income. To get to EBITDA, we have to add back the depreciation, which is 50,000. I just made that 10% of the fixed assets, and then 30,000 in interest, which is they have 750,000 in bank debt, and let's say they're paying 4% interest, so 30,000 in interest, and then A&A. That means add backs and adjustments. So we add back excessive compensation to the owners if that's the case, excessive rent to the owners if that's the case, non-recurring things, and we come up with an adjusted EBITDA of $400,000. Now maybe you have a little bit different opinion on what this distributor is worth, but if you're the buyer, you're thinking about stuff like this. That pre-tax income, is it subject to a lot of shrinkage? Will there be what will be the compounded annual growth rate be from here going forward? What about deferred capital expenditures? Am I going to have to put a lot of money in the business after I buy it? What's my feeling about the outlook for interest rates? Am I going to have to use a lot of working capital financing for this company to support their inventory and receivables? See you there, Gloria. And then the add backs and adjustments, are they rock solid or are they kind of inflated? And then finally, if you're using an MBA approach, what's your discount rate on terminal value? Time for a question.
Yes, Kathy asked another great question. Assuming a distributor has good ROI and has a deal pending with a PE firm, what are the leading reasons for the deal to fall through? She says, we've seen variables such as multiple ERP systems, the distributor hasn't harmonized, aging truck fleet, et cetera, as being reasons PE firms cancel the deal, not wanting to invest.
I don't disagree. In the case of a strategic buyer, it's different. They already have a computer system. They don't care which one you're using because you're not going to be using that one after the deal. But private equity firm, they don't have all those things. When they're buying a company, they're very interested in what is the status of that ERP system? Are they on the current version? Are the people power users of that system? Does the system work well? Can they come up with prompt, accurate financial statements? Is the inventory in good shape? What about the receivables? What about, as she said in that question, Kathy, the state of the equipment, of the forklifts? They all have to be replaced. The trucks, delivery trucks. So all that stuff is important. But then, if you look at the things that are in red there, Kathy, what the private equity fund is also concerned about is what is the solidity of the add backs and adjustments? What is our thought process on interest rates? Because we're borrowing a ton of the money we're using to buy this company. So there are any number of reasons why I would say overall of the deals that are in a letter of intent state, they're not binding, a non-binding letter of intent. About 20% of the time those deals fall through. And I think if I had to pick one reason is when the buyer gets into the due diligence in the data room and they are doing their homework, they will do a market study, they will do a quality of earnings study. If they find things they don't like, they may come back and want to renegotiate the price, or they may say, we don't want to own this company. And I will tell you, I'm on the board. I'm a founding board member of a private equity fund in Florida that invests in distributors. It's called Supply Chain Equity Partners. No secrets here. We look at a lot of deals every year, and we try very hard to close every deal that we get into a letter of intent on. That's very important to our reputation as a buyer. But there are at times, there have been rare cases where what the would-be seller presented us in terms of the information that was provided in the confidential information memorandum and so on, that information turned out to not be reliable. So I'll keep going, okay?
Thank you.
Good.
Thanks, Kathy.
Yes, keep them coming. So anyway, let me give you some illustrations. Let's say this company was sold for 5 times adjusted EBITDA. That's $2 million. That equals 20% of sales, 200% of net book value, It's 80, interesting point here, 80% of the gross profit. And a lot of times what a buyer, a strategic buyer especially, is looking for is how many gross profit dollars am I going to get out of this deal? Because that's what I really care about. The implied return on investment on this transaction would be, if the multiple's 5, the implied return on investment is 20%, meaning I feel I should get 20% return on investment for taking this risk. So another example, a 6 times multiple, the implied ROI is lower, meaning I'm willing to accept a lower return because I feel more comfortable with this transaction. I'm also paying almost 100 cents on the dollar for the gross profit. Here's another one, 7 times, same company. I'm willing to pay 2.8 million. My implied return on investment here is 14%. And then finally, let's get to the shoot the moon here. 8 times multiple, a valuation of 3.2 million on the same company. I'm paying 32 cents on the sales dollar and 3.2 times net book value, which means there's going to be a lot of goodwill on my balance sheet as the buyer. And I'm paying $1.28 for every dollar of gross profit, and my implied ROI is 12.5%. Not to be mysterious, but 8 times 12.5 equals 100. That's how that works. So you have the inverse relationships like you do in a real estate deal. So there's a valuation example, and this is just to show you what happened in multiples on large distribution transactions in the pandemic period so far. You see they bounced back. There was a V-shaped recovery. Those multiples bounced back, and in the case of industrial, stronger than before. So, but those are for large transactions. So please don't be misled. This little example, this is from MSC Industrial Corporation, and this is for industrial distributors, but the same logic applies pretty much everywhere. In the case of distribution businesses, a very small percentage of them are really large, meaning over 250 employees. I'm using that as an example. Yet they account for 40% of their revenue. So, from a strategic buyer's vantage point, those are the buyers. And the rest of them are the sellers. 86% of them are very small, 1 to 9 employees. They generally, they might be purchased by another local distributor who would tuck them into their company. Even the 10 to 49 distributors, not too many of those, and the greatest interest would be in the medium-sized ones. So you have to look at the relationships from the viewpoint of the buyer. Gloria, I think we have time for one more poll. Will we try this one out right now? Here we go. If you're a seller, what is your appetite for accepting part of the purchase price in the form of debt? A little bit, a larger portion if it's well secured. I would accept cash at closing only, or it depends. So those are 4 choices of your appetite for accepting part of the purchase price in debt. And Gloria, let's see what they say.
I'm going to let this just work its magic for a few more seconds because we're getting some last minute stragglers in. We have a 52% response ratio. I'm going to count down to 0, and then we'll go ahead and close.
Sounds good.
So 5, 4, 3, 2, 1.
Bingo. Oh, here we go. Would consider a small portion in debt, 43%. Would consider some, but only if well secured, 21. I'm with you on that. If I'm going to accept a large chunk of that purchase price in debt, I want security. There are a lot of good ways to secure it. That's what we have good lawyers for. Accepting cash and closing only, I would say, if that's your feeling, you might want to rethink that, because there may be some sellers who are asking a price that's just out of the reach of the buyer. And the buyer might say, look, I'm willing to meet your ask, but only if that last portion of it can be in the form of debt. And then you have to decide how much security you need. And then I like the answer, it depends, because it certainly depends on the situation, including the credit worthiness of the buyer. But guys, I would say it always pays to keep an open mind. You may have some sort of preconceived notions on things, but when you're selling your company, you really have to put some of those things aside and say, let's see what happens here, because every deal is a trade-off between price and terms, and this is a terms issue. And typically, the rule of thumb might be you may get the price you want, but you'll probably have to make some concessions on the terms, or the other way around. Okay, so we'll continue, kind of in the home stretch here. I just want to talk a little bit about, from a seller's viewpoint, how to make a deal happen, how to get it started. And one thing I think you should do to start with is think about who out there whom you know might buy your company. Many of us feel like, hey, you know what? I already know all the possible buyers for my business. In fact, I would never hire any investment banker or anybody to help me because I know every possible buyer. I have a list of all the people who've called me in the last 10 years. Well, yeah, but just because they call you doesn't mean it's a good fit. And of course, there are variables there like how do they go to market their sales force? Is it straight commission? Is it salary? Would we fit together if we were integrated into their company? Are we strong in electronic commerce and they're not? That would be good. If we bring that to the table, what if they're very strong in e-commerce and we're not? Then they're going to kind of downgrade us a bit for that. It's wonderful if there's a fit in ERP systems. If an Infor user buys another Infor user, that's great. I'm thinking, SX.enterprise, something like this that's seamless. You're going to be on different versions, but it's not going to be speaking a foreign language when you integrate. I think sometimes people go to user group meetings because they're looking for prospective companies to buy. I'm sure that doesn't surprise anybody that much. Our turnaround's okay. If I'm a turnaround company, I'm not in great financial shape. I have to find buyers who that's okay with them. Management staying or not. We alluded to that in our polling question earlier. If they want management to stay, but I've absolutely determined I don't want to, that wouldn't be a good fit. If a PE company buys my firm, am I willing to roll over some of the proceeds into ownership of the new company? I've seen it happen where the owner rolls over some money, stays working for the company for another 5 years, and when they sell their small portion later, they get more than they got for selling the large portion initially. So that can happen. And I guess I better explain what I mean in the upper left-hand box. A tuck-in is where somebody local buys your company and they just mash the two together, probably close your location, get rid of a lot of your people, and just keep it going as part of their business under their name. Adjacent market might mean want to get into another. I'm in Cleveland. I want to get into business in Pittsburgh. I'm going to go over there and pick a company in a nearby market, as opposed to a platform which is buying a company that's a self-standing business that's got it all, very deep and strong management, etc. Different type of a company to buy. So anyway, I think the rest is self-explanatory, but the culture question, the lower right-hand box, that's a big one. You can't take two companies with two cultures that don't fit together at all. Even if they strategically look good on paper, buyers know they don't buy a company that has a bad fit culturally. It's just a recipe for disaster. You have to consider your value proposition as a seller, just like if you're selling products to your customers. Are you growing? Are you growing your margins? Do you have diversity in your customer base and in your vendor base? Do you have some exclusive or selective suppliers? Buyers love that. Do you have a younger sales and management team? Unfortunately for us distributors out there, one of our problems is that the median age of our sales force might be 55 or 6. That means they're pretty close to retirement and maybe they're not working as hard anymore, or something that a buyer would not really be too crazy about. So think of that, the sales team, management team. Are you good at controlling costs, managing assets? Do you have a good facility that would be a good one to move into? Is it really well located where it would be advantageous? Or is it a facility the buyer would like to stay in as little as possible, or maybe not at all? And there's culture again. Now, back to a question Kathy asked earlier about how to attract solid offers. Please note the asterisks, because I'm saying here at the bottom, it's all about who. Who is going to identify and approach buyers? Who's going to run a process? I'll tell you a little bit more about that too. Who's the right person to be really running the deal? And it might not be somebody who's already got a full-time job at the company and has no time. who's the right person to get legal and accounting advice from? I would always say if you're selling your business, find a lawyer who has experience in M&A. Maybe that's the only thing they do. And an accountant who's got a lot of experience with deals. Many distributors have small lawyers, small accounting firms rather, that those firms don't have the experience. And your lawyer or accountant assure you that they can do everything for you. Maybe they can, but they probably can't. And the other thing is, if you're their largest client, they're not terribly interested in your selling your business because they don't want to lose a large client. I think that's probably pretty obvious. Big question too is how much information to share and when. I think sellers tend to overshare. They start selling the company instead of letting the other party buy it. And the buyers, believe me, they'll listen to everything that you say. They want to hear every little nuance that they can get. They'll write it all down. They'll check it all out too. But everything you say can and will be used against you in the negotiations. So careful. As far as running a process, if you want to uncover private equity buyers, you really have to have a credible advisor who can put together a confidential information memorandum. And I don't want to jump ahead. That's on the next slide, I think. But I'll put together also a teaser that will go to prospective buyers that they will open and read and take seriously. A lot of envelopes, I can tell you, that come in every day. Private equity funds end up in the wastebasket unopened. So the who's representing the seller is really important. That also indicates that you're serious. As far as having a teaser, I think I already mentioned how that works, but a confidential information memorandum is much more detailed than a teaser, and you must have a non-disclosure agreement in effect to share that type of information. And also, you do not want to give it to anybody you would not be interested in selling the company to, because it's going to get out there. And the rest of it is probably things you know about, but an indication of interest would be where a seller says, I am interested in this company. Here's an approximate range in value. Then the person who's representing you will then negotiate to find out if they're in the range of price that you're willing to accept, and then you don't want to get into final negotiations with more than two or at most three parties. But then you get to a letter of intent, which is non-binding, that leads to due diligence, which is where most deals, if they're going to fall apart, that's where they fall apart. Time is the enemy. You need somebody to shepherd it through and get it done. And also remembering that many times deals fall apart and they need to be resurrected. You're back with a question, or are you telling me we're out of time?
No, I'm back with a question.
Okay.
Kathy Lundquist is not only a valued TUG member, but she's also an esteemed network leader. She comes up
Okay.
with some great questions, and this is
Good.
one that she's posing. What determines how long a PE firm holds onto a distributor when they flip to the next PE?
All right. That's a great question. The answer is we want to hold on to it as little as possible. We would like to, let's say, buy a company. I'm speaking like I'm an investor here. I'm an investor in an investor, but I'm not a PE fund, but let me speak for them. They want to own it for as little time as possible, but as much time as needed to follow through on their investment theory or their investment story. If the hypothesis is, I'm going to buy Kathy's company and I'm going to add on three more like Kathy, I'm going to make it into a bigger company and I'm going to make money by making it bigger and get a better multiple. That's an investment thesis. Another investment thesis might be I'm going to get into some adjacent markets and just have broader, better market coverage. I'm going to add some products. I'm going to do this. That. Those things take time. So the typical holding period would be 5 to 7 years. But it's a real windfall when a buyer appears after 2 years, wants to buy the company, and that the reason behind that is you're giving your investors an annualized return on investment, which is much higher. Why? You make a big return, but the holding period is less, so the annual return on investment is higher. So 5 to 7 years, sometimes they get to be 10 to 11 years, and there's a lot of anxiety because the investors at the PE fund want to get their money out and move on to the next thing. So that would be my answer for Kathy on this one.
Great. I'm going to go back off camera so you can finish.
Okay, good. Yep, almost done here. I said time is the enemy of all deals, and that most deals fall apart at least once. Sometimes a seller needs someone to to hold their hand, to keep it going, to smooth over the rough patches. If it needs to be renegotiated, to get that done. There are a lot of things that I think an outsider can assist with. So obviously, that's my bias. The due diligence that a buyer undertakes, they do a quality of earnings study. They want to be sure that your financial statements, even if they're audited, that there's nothing there that they're uncomfortable with, that the add backs and adjustments are rock solid. They want to have a data room, and that's something that an advisor puts together for the seller to get information without coming in the seller's business and disrupting daily life. There may be attempts to renegotiate, and sometimes they back out. And when that happens, you have to do some damage control because even though there's a definitive purchase agreement, some of those deals fall apart when the agreement's drafted because the buyer's attorney rather prepares this. There are a lot of considerations there, tax considerations. Are we going to buy assets or stock? What's the working capital requirement? Escrows for unsaleable inventory, receivables, reps, and warranties, changing the closing date. Lots of things happen that cause these things to fall through. What are the risks? Unfortunately, this is bad news. For distributors, it's pretty risky putting your company on the market because your key people, especially your salespeople, get very nervous when they find out the company's for sale. And you sometimes find that your salespeople from your competitors are going around telling your longtime customers that you're selling, that they better switch now. They tell vendors that vendors get nervous that the new owner's not going to support them properly. And you can end up spending a lot of money in professional fees, waste a lot of time, and miss other selling opportunities by getting close to a deal with the wrong buyer. So again, there are risks. Of course, the rewards are proportionate to the risks, but that can happen. So, after the closing, some things that you have to think about as a seller. How much of the spoils are you willing to share with your people? Be aware there could be post-closing adjustments under your agreement with your seller, with your buyer rather, about the amount of receivables and inventory that are left behind, that there are some tax issues. Maybe there's an old sales tax audit that comes up. So there could be employee-related matters, including employee practices liability issues. The definitive purchase agreement is not the only thing. The employment and consulting agreements for yourself as a former owner are very important because they define what you have to do to get the money and how much you're going to get. And remember, too, that's ordinary income, not capital gains at that point. And then there's real estate taxes. I'm sorry, real estate considerations. So, of course, taxes are one thing. But do you want to keep the real estate? Do you want to lease it to the new buyer? Do you want to sell it to somebody else? Typically, the real estate's a very important factor because it's a large chunk of the total value. And besides this advertisement for my book, Shameless Self-Promotion, I don't really get much if you buy one, but it's a good book. I wrote part of it. I edited also a portion of it that was written by an outside investment banker, a deal attorney, and CPA. And I think you will find it interesting. You can get the free pocket guide and see if you want to invest whatever it costs to buy one of those books. Or call me. I'll answer any question by email or on the phone, no charge or anything like that. I'm going to throw in a comment about taxes, though, before I sign off. I have to do this. Please remember, Congress has talked about dramatically increasing income taxes. The capital gains rate, they're talking about going from 20% to 39.6%. If you're in a state where there are high state income taxes, like California or New York, those are no longer deductible from your federal taxes. Talk to your lawyer, talk to your accountant. I would say right now, this is a very good time for sellers to speed it up. And I think it's a good time for buyers to slow it down. But I'm talking to sellers today. So that's my story, Gloria. I'm sticking with it.
And you're sticking to it. I didn't see any other questions populate. And for starters, I want to thank everyone from TUG that has joined us online. We continue to be so thankful to presenters like Brent who come online and share their wealth of information. So Brent, a very, very, very profound thank you to you. And also, if you want to continue this conversation internally, for those of you that are TUG members, feel free to continue this dialogue on our forum boards. And then also, we will be having the recording available on the following business day. And for those of you who are not yet TUG members, I have to say, why? Join today. You can see what great content we have, and also that which we keep behind our membership curtain. So without any further ado, I want to also remind you that we have an upcoming webinar next Tuesday that should have hit your mailboxes already. And also I know that have been posted to the board. So as they say in Hollywood, thanks again, Brent. And that's a wrap.
Thank you.